When people ask me about the secret to wealth, I usually smile and say, start early, live long, and let compound interest do the heavy lifting. It sounds simple, maybe even too simple, but behind those few words lies the whole story of my life. I grew up in Omaha during the Depression. Money was tight for almost everyone, yet I was fascinated by it. Not the spending of it, but what it could do when left alone. I'd read the stock pages the way other boys read the sports section. While they memorized batting averages, I memorized ticker symbols. At age 11, I bought my first stock, 3 shares of City Service Preferred at $38 a share. I thought I was a miniature Rockefeller. The price dropped to $27 and I nearly fainted. I held on, and when it climbed back to $40, I sold. I made $5. I was thrilled, until the stock shot up to $200 soon after. That's when I learned my first lesson. Good things take time. That little episode planted a seed. I realized that wealth isn't made in bursts. It compounds slowly, quietly, invisibly at first, like a snowball rolling down a hill, picking up flakes so small you can barely see them, until one day it's a boulder. People think I'm some kind of investing genius. I'm not. What I am is patient. Compounding rewards patience more than brilliance. If you understand that, you already know half of what made me successful. When I was young, I loved to picture compound interest as a snowball rolling down a very long hill. The longer the hill, the bigger the snowball becomes. My job, I figured, was to start rolling early and find the longest, steepest hill I could. Let's put some numbers behind that image. Suppose you invest $100 at 10%. After a year, you've got $110. Leave it alone another year, and it's $121. Not impressive? Stretch that over 50 years. It becomes nearly $11,700. The math doesn't look magical, but the time is. Time turns ordinary returns into extraordinary results. I started early, but I also lived long. At 20, I was reading every annual report I could find. At 30, I was running partnerships. By 60, the snowball had turned into Berkshire Hathaway. None of it happened overnight. Young people sometimes say, "Why, Warren, I missed my chance." No, you didn't. Time is generous if you respect it. The sooner you stop interrupting compounding by spending every dollar by chasing quick profits, the sooner it starts working for you. The stock market is a mechanism that transfers money from the impatient to the patient. Every time someone panics and sells, someone else calmly buys and lets compounding keep working. Guess which side wins over a lifetime? My understanding of compounding didn't begin with stocks. It began with newspapers. As a boy, I had several routes, hundreds of papers delivered before dawn. I earned about $100 to $75 a month, which was real money back then. Most kids spent theirs on candy or bikes. I saved mine and bought pinball machines. That little enterprise taught me something profound. One machine made a few quarters a day. I didn't spend them. I bought another machine. Before long, I had dozens across Omaha. My profits were working for me instead of sitting idle. That's compounding in miniature. Your assets earning returns, and those returns buying more assets that earn more returns. When I later invested in businesses, I looked for the same principle on a larger scale. Companies that could reinvest profits at high rates without outside help. Coca-Cola, for instance, earns money every time someone opens a bottle, then reinvests in marketing and distribution, which sells even more bottles. That's a snowball made of sugar water. The trick isn't finding magic formulas, it's spotting steady, repeatable growth and letting it run. My pinball route grew not because I was brilliant, but because I didn't interfere. I let the quarters roll. Compounding has a silent partner, patience. You can't separate them. People love excitement. They want action, movement, headlines. But wealth happens quietly in the background. When I buy a business, I'm not thinking about next quarter. I'm thinking about 10, 20 years. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Patience isn't passive, it's disciplined restraint. Every day the world tempts you to fiddle with your portfolio to grab quick gains. Every trade has a cost, commissions, taxes, and worst of all, the break in compounding. Charlie Munger once said, "The big money is not in the buying or the selling, but in the waiting." That's true in investing and in life. Consider the oak tree. It grows imperceptibly, ring by ring, year after year. You never hear it growing, but one day it towers above everything around it. That's what patience looks like financially. When I was 30, I wasn't rich. When I was 50, I was comfortable. Most of my net worth appeared after I turned 60. That's the nature of exponential growth. It creeps, then leaps. People quit just before the leap. Don't. Everything powerful has a dark side. Compounding works for you when you save, but it also works against you when you borrow. Credit card debt is compound interest in reverse. At 20% interest, your balance doubles roughly every 3.5 years. I've met people drowning not because they didn't earn enough, but because they let negative compounding run wild. If you want to harness compounding, first plug the leaks. Pay off high-interest debt. Only then can your money start rolling downhill instead of up. I tell students you can't out-invest bad habits. If you earn 10% in the market but pay 20% on credit cards, you're sprinting backward. Debt is easy to get into and hard to escape precisely because of compounding. Interest on interest piles up faster than you can shovel. So remember, compounding is impartial. It doesn't care who you are, it obeys math, not morality. Use it wisely and it will carry you. Misuse it and it will crush you. The same force that builds fortunes can also bury them. When I talk about compounding, people often ask, Warren, does it work with any investment? Well, not quite. You can roll a snowball on gravel all you like. It won't pick up much snow. You need the right kind of hill and the right kind of snow. In investing, that means quality businesses that earn good returns on capital, can reinvest those returns at similar or higher rates, and have staying power. When I first bought shares in American Express after the salad oil scandal, people thought I'd lost my mind. The company's reputation was bruised, but its core business, the charge card, was sound and growing. I saw a long hill covered in good snow. I invested and then let time do its job. The same pattern repeated with Coca-Cola, See's Candies, and later Apple. Each of these companies had something special. A product people loved, a brand that stuck, a moat that protected it, and management that knew how to reinvest earnings wisely. That's the essence of finding good snow. Compounding only works when the underlying business continues to grow. A 10% return reinvested in a rotten business still gives you trouble. A 10% return reinvested in a wonderful business, that becomes 15%, then 20%, as the moat widens and efficiencies multiply. So don't just look for high returns, look for sustainable returns, the kind that endure through recessions, competition, and fashion changes. Remember, compounding doesn't just add up profits, it multiplies them when the base is solid. Good snow, long hill, that's the secret combination. Early in my career, I ran partnerships. We had rules. Partners could withdraw only once a year. We didn't sell just because prices moved. We reinvested profits instead of distributing them. Why? To keep compounding uninterrupted. I told my partners, if you need excitement, go to the racetrack. Investing with me would be dull most days. Yet the dull years turned out to be the most productive. Think of compounding as a marathon relay. Each dollar you save hands the baton to the next dollar you earn. If you break the chain, withdraw too soon, you stop the race. At Berkshire Hathaway, we do the same thing on a larger scale. We retain earnings and let our managers deploy them where returns are best. Over decades, that habit transformed a struggling textile mill into a conglomerate worth hundreds of billions. Every year, people ask why we don't pay a dividend. I tell them, the math of reinvestment is too powerful. We can earn more on a retained dollar inside Berkshire than you can outside it after taxes. That's compounding with partners. You can adopt the same principle individually. Reinvest your dividends, your bonuses, your learning. Keep every new dollar working for you. Over time, that team of dollars becomes unstoppable. Compounding demands patience. Patience demands emotional control. Markets are manic. They'll seduce you in euphoria and scare you in panic. If you let emotion dictate action, you interrupt compounding, the worst sin in investing. During the 1970s, inflation soared and stocks went nowhere. People swore off equities. But we kept buying businesses. We knew that intrinsic value compounds even when prices sleep. 10 years later, the world realized it too. The 2008 financial crisis tested the same nerve. Berkshire's market value dropped tens of billions on paper, but the businesses we owned, railroads, insurers, candy companies, still earned money. Their compounding machines hadn't stopped, only the crowd's enthusiasm had. Emotion whispers lies, do something, anything. Wisdom replies, sit still. You can't grow a tree faster by pulling its branches, you just damage the roots. Compounding needs calm soil. The best investors I know share one trait, equanimity. They don't get too high when things go right or too low when they go wrong. They understand that volatility is the price you pay for long-term gain. So build your emotional moat. Turn off the tickers, ignore the noise, and give compounding the silence it loves. Money isn't the only thing that compounds. Knowledge does too. Every book you read, every experience you digest adds a small layer to your understanding. Over decades, that understanding becomes wisdom, and wisdom pays the highest dividends. When I was a young man, I read Benjamin Graham's The Intelligent Investor and Security Analysis so many times that the pages nearly fell out. Those ideas compounded inside me. They influenced how I evaluated businesses, partnerships, and even people. Later, Charlie Munger broadened my view. He taught me mental models from psychology, physics, biology, how to see the world as an interconnected system. Once you grasp that, your decision-making compounds too. Each insight builds on the last. That's why I still spend most of my day reading. Some folks think I'm lazy because I sit around with my nose in reports. But reading is my form of capital expenditure. It feeds the compounding machine of the mind. You should do the same. Learn continuously. Let curiosity roll downhill. The return on invested knowledge beats almost everything else. You don't need extraordinary returns to get extraordinary results. That's the beauty of compounding. Let's run the math. A 10% annual return doubles your money roughly every 7 years. A 15% return doubles it every 5. Small differences explode over time. If two investors start with $10,000, one earns 8%, the other 10% for 40 years. The first ends up with $217,000. The second with $452,000. Same time, same starting point, just a tiny edge. That's why I'm obsessed with avoiding mistakes. The surest way to earn high returns is not to lose money. Rule number 1, never lose money. Rule number 2, never forget rule number 1, protect your principal. Avoid speculation, keep costs low. Those habits preserve your compounding rate. Even a 1% annual drag from fees or taxes can slice millions off a lifetime of investing. The miracle lies not in genius, but in discipline. If you can maintain even a modest edge consistently, time will amplify it beyond imagination. That's how fortunes and lives are built. Not by chasing lightning, but by harnessing steady rain. If I could give you one gift, it would be time. Time is the friend of the wonderful business and the enemy of the mediocre one. It's also the best partner any investor can have because it never asks for a raise and it never sleeps. The older I get, the more I realize that time does the heavy lifting. You do a few smart things. Buy well, stay rational, keep costs low, and then you let time multiply your good decisions. People talk about timing the market. I've never met anyone who could do it consistently. What matters is time in the market, not timing the market. If you bought a farm, would you sell it because one bad season came along? Of course not. You'd tend the soil, fix the fences, and wait for spring. Investing is the same. The harvest belongs to those who wait through the winters. In my 90s, I can tell you something with certainty. The compounding of time is more precious than the compounding of money. You can always earn another dollar. You can't earn another year. Use it wisely. Start early, be patient, and let time be your silent partner. When I was young, my dad told me it takes 20 years to build a reputation and 5 minutes to ruin it. I've lived long enough to see that truth compound too. Trust is a form of capital. Each honest act adds a small deposit to your reputation account. Each dishonest act withdraws from it with interest. When people trust you, opportunities compound. You get better partners, better deals, better friends. That's why I tell our managers at Berkshire, lose money for the firm and I will be understanding. Lose a shred of reputation and I will be ruthless. Integrity compounds the same way returns do, quietly, invisibly, but powerfully. When your word is good, your future cost of capital goes down. You need fewer contracts, fewer lawyers, fewer apologies. And just like financial compounding, reputation can work against you if you abuse it. A single dishonest moment can undo decades of careful growth. So guard it like you'd guard your principal. Let honesty, humility, and fairness accrue daily interest. Over a lifetime, the yield is extraordinary. Some people think the joy of wealth is buying things. They're wrong. The real joy is seeing knowledge and opportunity compound in others. I've spent years talking with students, sometimes in small classrooms, sometimes in big arenas. Every time I see myself in those curious faces. If one of them starts saving early, learns patience, and passes that lesson forward, the ripple never ends. Teaching is compounding too. Each person you help becomes a seed. They grow, they teach others, and the forest expands. That's why I created the Giving Pledge with Bill Gates. Money can compound, but so can generosity. If you give wisely, the benefits multiply far beyond what a single fortune could do sitting idle. When I give, I'm not parting with wealth. I'm redeploying it, putting my snowball on a new hill where it can keep rolling, gathering opportunity for others. If you ever doubt the power of compounding, look at a good idea spreading through generations. That's the human version of compound interest. An idea earning interest in minds and hearts. People often ask, Warren, what keeps you content? The answer lies in what I call the inner scorecard. Most folks live by the outer scorecard, what others think of them. The trouble is that score changes every day. The inner scorecard measures how you behave when nobody's watching. Compounding isn't only financial, it's moral. Each time you act with integrity, you strengthen the muscle of good judgment. Each time you choose patience over greed, humility over pride, you add interest to your character account. Over decades, that shapes who you become far more than your bank balance does. I know billionaires who are miserable because their inner scorecard is empty. And I know teachers, farmers, and small-town shopkeepers who are rich in every way that counts. When you follow your inner scorecard, you sleep well, you think clearly, and you attract the right partners. That's a different kind of compounding. One that builds peace instead of anxiety. In the long run, the market weighs your reputation the same way it weighs a business's earnings. Make sure your character compounds positively. If there's one picture I want to leave in your mind, it's that small snowball on a long hill. When I was 11, I rolled mine without realizing it. Decades later, it's still rolling. Not because I'm the smartest guy in the room, but because I respected time, reinvested consistently, and never stopped learning. You can do the same. You don't need a fortune to start, just a little discipline and a lot of patience. Here's the blueprint. Start now. Even the smallest snowball needs a push. Save before you spend. Make compounding automatic, not optional. Buy what you understand. A calm mind earns better returns than a busy one. Reinvest earnings. Never interrupt the snowball without good reason. Stay the course. Markets will roar and crash. Time will smooth them both. Let generosity, knowledge, and character compound too. Those dividends never decline. And above all, remember, compounding is not a get-rich-quick scheme. It's a get-rich-slow certainty. In my life, the numbers were just a byproduct. The real reward was watching the simple principle of patience turn into something extraordinary. You have the same power. Start your snowball today. Keep rolling it year after year. One day you'll look back down that hill and realize that the quietest force in the universe, compound interest, has carried you farther than you ever dreamed. Thank you for listening, and may your own snowball roll smoothly for a very, very long time. Remember to like and subscribe for the best investment strategies and advice from Warren Buffett. Listen to our next audiobooks below.